Markets appear calm on the surface, but beneath that calm, money is moving quietly, not into stocks, not into speculation, but into places investors usually turn when uncertainty rises. Today's story isn't about panic, it's about preparation. While headlines chase excitement, long-term investors are shifting positions with discipline and patience. Across the UK and the United States, fund flow data shows a clear pattern. Cash and bonds are attracting capital. Equities are being treated with caution. This movement isn't emotional, it's strategic, and it tells us more about the future than market prices alone ever could. To understand why this is happening, we need to look beyond charts and headlines. We need to look at incentives, risk, and capital preservation. Cash is often misunderstood. Many assume holding cash means fear or indecision. In reality, cash is optionality. Cash gives investors flexibility. It allows action when prices fall. It provides protection when conditions worsen. In uncertain environments, optionality becomes valuable. Investors are willing to sacrifice short-term returns for long-term control. This is not market timing, it's risk management. When capital preservation becomes the priority, behavior changes quietly, not loudly. Bonds tell a similar story. For years, bonds were dismissed as unattractive. Low yields made them irrelevant to many investors. But conditions change. Interest rates rise. Yields become meaningful again. Bonds regain their role. Bonds offer income, stability, and predictability. In uncertain markets, predictability matters. Investors are not chasing returns. They are choosing certainty. This shift reflects maturity, not pessimism. Fund flows are one of the most honest indicators in finance. Opinions can be misleading. Capital movements are not. In recent months, money market funds and fixed income products have seen consistent inflows. At the same time, equity funds have experienced hesitation and selective withdrawals. This doesn't signal collapse. It signals caution. Smart capital moves early, quietly, and without headlines. Why now? Because uncertainty has increased across multiple dimensions at the same time. Interest rate expectations remain unclear. Central bank credibility is being questioned. Political risk has returned. When multiple uncertainties overlap, risk compounds. Investors respond by reducing exposure to outcomes they cannot model. Cash and bonds reduce complexity. Equities thrive when visibility is high. When earnings, policy, and growth are predictable. When visibility declines, equity risk increases even if prices don't fall immediately. This is where many investors make mistakes. They wait for prices to move before adjusting risk. Experienced investors adjust before volatility arrives. That's what we're seeing now. This behavior aligns closely with Warren Buffett's philosophy. Buffett has always viewed cash as a strategic asset, not wasted potential. He waits patiently when valuations are unclear and acts decisively when opportunities emerge. Cash gives him the ability to say yes when others cannot. That mindset is spreading. Another factor driving this shift is yield competition. When risk-free or low-risk assets offer reasonable returns, the equity risk premium narrows. Investors begin asking harder questions about whether volatility is worth it. For many, the answer is temporarily no. That decision doesn't require fear, only discipline. There's also a psychological dimension to this shift. After years of speculation, many investors are experiencing fatigue. Volatility without progress erodes confidence. Cash provides emotional stability as much as financial stability. Calm investors make better decisions. Importantly, this movement is not uniform. Risk is not being eliminated. It's being concentrated selectively. High-quality assets are retained. Marginal risks are reduced. This is not a retreat. It's a repositioning. Understanding that distinction matters. Retail investors often misinterpret these shifts. They see markets holding up and assume confidence remains high, but prices reflect the last trade, not future intent. Fund flows reflect preparation, and preparation happens quietly. The reason investors favor bonds is duration control. Short-term bonds allow capital to stay productive without long-term commitment. This flexibility matters when policy paths are unclear. Investors are buying time. Time is an asset. Historically, these shifts often precede market transitions, not crashes necessarily, but changes in leadership, volatility, and opportunity. Cash builds pressure. Eventually, it must be deployed. That deployment defines the next cycle. Patience sets the stage. What this does not mean is abandoning equities permanently. Long-term ownership of strong businesses remains powerful. But timing exposure matters more when uncertainty rises. Risk should be earned, not assumed. That lesson is being relearned. For individual investors, the takeaway is simple. Observe behavior, not noise. Understand why capital moves before reacting to prices. Avoid forcing action in unclear environments. Inaction can be a decision. Cash and bonds are not the end goal. They are the bridge between cycles. They protect capital while waiting for clarity. Clarity eventually arrives. It always does. Markets reward patience more consistently than prediction. The quiet movement into cash and bonds reflects that truth. It is not fear, it is respect for uncertainty. Respect leads to survival. Survival enables compounding. When the next opportunity appears, prepared investors will act. They won't rush. They won't chase. They'll deploy capital with confidence and margin of safety because they waited. And in investing, waiting is often the most powerful move of all.